When estimating depreciation expense and capital expenditures in a cash flow forecast, first and foremost, the capital expenditures must be estimated. Some things to look at when making this forecast are the company's historical capital expenditures and their historical CapEx to revenue ratio, the industry's CapEx to revenue ratio, the capital expenditures that are forecast to see if they tie in with the growth rates that are forecast for the company. Once the capital expenditures are forecast, then you turn to look at the forecasted depreciation expense. This forecast is dependent upon the existence of any long-lived assets, the methods of depreciation being used, the growth projections in the company, and the average age of the assets that are being depreciated. An incorrect estimate of the difference between capital expenditures and depreciation expense in a cash flow forecast can impact a valuation. If depreciation expense is incorrectly set higher than capital expenditures in the terminal period cash flow forecast of a discounted cash flow, the value of the company will be overstated as the cash flow is overstated. Higher forecasted growth rates can cause a greater percentage difference between capital expenditures and depreciation. Also, the differences will be materially greater if a company uses straight line method of depreciation as opposed to accelerated methods of depreciation. It's important to distinguish between book depreciation and tax depreciation when forecasting normalized depreciation for evaluation. If a company is using book depreciation, that means they're relying on methods within generally accepted accounting principles, which are straight line methods. If they are using tax depreciation, these are accelerated methods. If an appraiser does not analyze which methods are being used, they may overstate depreciation in their forecast, for example, if the company has used accelerated methods, and this will cause an overvaluation of the company.